how IUL, Index Universal Life, can be used for lump sum transfers of money, what we call capital. In this episode, I'm going to do a little bit of a deep dive into how max funded Index Universal Life can be the dream solution for lump sums of money that you may receive from a car accident settlement or any kind of a settlement, maybe an inheritance, maybe a windfall of money or profit from the sale of a business or a pension, or even a tax-free death benefit from life insurance. So get ready. I think you're going to be blown away with some opportunities that maybe you didn't know existed before. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets and minimize taxes and empower what I call their true or authentic wealth. Now, my favorite financial vehicle, without question, for all kinds of financial goals is a properly structured max-funded IUL. It's the only vehicle in the Internal Revenue Code that allows you to accumulate your money totally income tax-free. That's provided under Section 72E of the Internal Revenue Code. You can access that money even before age 59 and a half. It's not a qualified account like an IRA or 401k. Totally income tax-free. You can generate tax-free income streams to where every $1 million you accumulate in a max-funded IUL that's structured correctly can generate an 8 to a 10% payout. $100,000 a year from $1 million nest egg, totally income tax-free for 30 or 40 years without depleting principal is what we've been able to do for many, many clients. Nothing else does that in the Internal Revenue Code, but I haven't finished. It's the only vehicle that when you ultimately die, it blossoms. Whatever you leave behind in there blossoms. It increases in value and transfers income tax-free. If I died in an accident tomorrow, every $1 million I might have in a portfolio of laser funds would blossom and pay out about double that, $2 million, to my family bank, which would benefit my wife, my kids, my grandkids as beneficiaries, okay? Totally tax-free. I've challenged CPAs and tax attorneys that I teach advanced continuing education to for years. Show me any other investment in America in the Internal Revenue Code that does that. They've yet to show me. So it's like the dream solution for many goals. So I compare it metaphorically to a financial Swiss Army knife. There's all of these uses for IUL. And on this channel and in a book I want to gift you at the end of this episode, you can read about all of these various applications, but it's the dream solution. It knocks the socks off of traditional IRAs and 401ks for your retirement planning. It usually doubles and even triples one's retirement income and allows you to participate when the market goes up, but you don't lose when the market goes down. Wall Street was not designed to create predictable income. Most Americans are way too top heavy with money in yet to be taxed IRAs or 401ks invested in the market. That's why we do strategic rollouts with this tax reduction strategy to get taxes over and done with sooner than later into a max funded IUL. And we oftentimes will double or triple their retirement income. There's real stories in the Laser Fund book illustrating this. We do this all the time, where we are able to increase someone's income from $50,000 up to $120,000 or $150,000 on the same amount of money in an IUL versus their IRAs or 401ks based upon money in the market with a 4% rule payout. That's all they want you to pull out is 4% because that's the average. Actually, only about 3.5% is the average for people in retirement if they have their money in the market in IRAs or 401ks. Did you know that? They don't want to be sued. I'm talking about broker-dealers and asset managers. They don't want to be sued by you for you outliving your money. And so they say, don't take out any more than 4%. If you do, you have to sign this hold harmless agreement that you won't sue us. You'll hold us harmless for you outliving your money. That's ridiculous. It's unacceptable to me. So it's really good for retirement planning. A death benefit comes along for the ride, but that's secondary. With max-funded IUL, you're taking the least amount of insurance or death benefit you can get away with, and you're putting in the most money the IRS allows as fast as they allow. If you're socking away money for college funding, this knocks the socks up of a 529 college savings plan with way more flexibility. And your child or grandchild doesn't have to use the money in an IUL for college. It's still tax-free. With a 529, they have to use it for college. If they use it for a down payment on a home or to start a business, they have to pay tax. Working capital account for business owners. Read that in my book I want to gift you. This is where a lot of savvy real estate investors and business owners become their own banker, and they use money in their IUL where they can access it, and they actually are borrowing from an insurance company using their IUL cash value as collateral, and they're borrowing the money at 2% or 5%, and they keep earning 10, 15, 20, 25% or higher. And so they are earning a great rate of return on their money that's collateralizing the loan they get from the insurance company using the cash values as collateral. It's an incredible strategy. Okay, that's for business owners. Estate planning, you're able to have a death benefit that, not only will the insurance create maybe double or triple the income. Why would you generate, $100,000 of income when you could generate 3 times that, 300,000 on the same asset? Maybe your estate's worth $3 million. And at the end of the day, on top of that, why would you leave behind $3 million when you could leave behind $6 million tax-free? That's what IUL does. It creates more income and it leaves behind way more money when you die. It's used as emergency funds because, frankly, banks and credit unions take 30 to 40% of the money they have in their Tier 1 assets, and they invest it in insurance companies for higher safety. A lot of these insurance companies are rated AAA. Many banks are only rated BBB. That's 6 notches higher in safety. And they earn a rate of return that's double, triple, even 5 times what they're paying the depositors in their bank. Okay, they understand how money works. But pension maximization would be for school teachers, police officers, firefighters to maximize the pension they get from the state where they retire. Let's get back over here to lump sums. A lot of times people don't think about this. What do I do with this lump sum of money that I've got? And we call this capital. Money is capital, okay? So I, for 50 years, have called this capital transfer. Okay, so let's focus on a lump sum capital transfer. There are, a handful, 5, 6 general categories that I usually come across where Americans have lump sums that sort of all of a sudden they don't know what to do with this lump sum of money. So this could be an inheritance. Many times clients who got an inheritance or are expecting an inheritance because their parent, the second to die maybe, had a stroke and they're on hospice and they're going to pass away and they know they're going to receive $500,000 or $1 million or $5 million. And they say, Doug, what should I do with this money? And I would say, I would put it into max funded IUL and you can use it to accumulate your money tax-free from that point forward at nice rates of return averaging 8 to 10% by rebalancing every year. And we'll help you do that. But when you need to turn on income, you can access the money for any purpose. But if you just want to live off of the money you're earning, you could probably pull out 10% a year without depleting principal the rest of your life. Every million can generate $100,000 a year of tax-free income. And so we accommodate money that people get from an inheritance. Maybe it's a settlement from a car accident or other types of settlements that you make. And you wonder, what do I do with this $500,000 settlement? You can put it into IUL. Now, you can't put it in one fell swoop if that's the only asset you put into the IUL, because the IRS says if you put in the lump sum, it will create what is called a MEC if you take the minimum death benefit. That's a modified endowment contract. And so that means your money still accumulates tax deferred, but when you go to access your money, it's now taxable. Most people want to access their money tax-free. They want to earn tax-free growth and they want to access the money tax-free. So you have to comply with a tax citation called TAMRA to avoid a MEC. And if you accidentally create a MEC, you can perfect a MEC by asking for a refund from the insurance company within a 60-day window during the next after the next policy anniversary when you accidentally put in more than the IRS allowed. Now, we watch that very, very close with the advisors that I train and teach. But if you have a lump sum, let's say you get 500,000 and you're over age 55, you may only be able to put in about 125,000, about 25% a year for 4 years. But in actuality, under the Internal Revenue Code guidelines, you could put in 125,000 of that 500,000 the first day of the first year, and another 125,000 the first day of the second year. That's 1 year and 1 day. So basically, within a year and a day, you've got it half full. In 3 years and 1 day, you've got all of that 500,000 in there, and now it's totally tax-free when you access all your interest and growth on that account. Okay, that's because you made it compliant with TAMRA. And so you want to talk to an IUL specialist who understands how to do that and not have any more death benefit than is necessary so you don't suffer on rate of return. That's crucial. Sometimes people get an offer of a lump sum pension. And frankly, most of the time, not 100% of the time, if the government or the corporation where you work says, well, you can take a monthly income the rest of your life, or you can just take a lump sum. Generally speaking, I recommend the lump sum. You can do the math because if they give you a monthly income, it's usually only based on maybe a 5 or 6% average rate of return. And an IUL can actually, if you structure it correctly, fund it properly, you can generate more of an 8 to 10% payout or rate of return on that money. So many times people can take a lump sum pension and do better than taking the monthly income the rest of your life. And another problem with a pension is if you die, it's gone, unless you took a lower pension and named a survivor for that, but you have to take a lower income. It'd be far better to take the gross income and take the differential and put it into an IUL, or simply take the lump sum option. An insurance death benefit, when somebody passes away and they die, one of the beauties of life insurance is that life insurance proceeds, if you're the beneficiary of a life insurance policy, that's income tax free. But it's also not subject to the claims of the creditors of the deceased. That's one of the big legal advantages. And so oftentimes people will say, Doug, I'm getting a life insurance death benefit, or I got one. What should I do with this money? Now, sadly, most widows in America are told by their friends and even some well-intending advisors, oh, so you got $500,000 or $1 million life insurance death benefit. Pay off your house. Now, to me, that's probably the worst advice for most widows. Don't pay off your house. Why? Because I've seen so many widows that within 2 to 3 years, they're now trying to establish their own credit worthiness, their own credit rating. And they ruined it by paying off the house, maybe the only liability. They paid off their house and all their debt. Now they have to go out and borrow, and it's hard to borrow when you don't have a credit rating. Hello? And so most of the widows that I've talked to, when I sit down with their attorneys, they realize, no, let's keep the $1 million. What should we do? It's tax-free. Let's keep it tax-free by doing what? Putting it back into another insurance policy. We maximum fund another insurance policy. So if a widow at age 65 gets $1 million of tax-free death benefit, I say, well, let's put it back into a new IUL on your life, and the death benefit will be $2 million at the end of the day. So every time, when you pass away, now your estate's going to leave behind even twice as much again. But that $1 million in your max funded IUL, generating 8 to 10% a year, I mean, your mortgage might be 6% interest tax deductible. In a 33% bracket, that's a net cost of 4%. Why would you pay off a mortgage at 4% net? In other words, why on a $1 million mortgage that you're only paying a net of 4% on, that's only $40,000 a year when you're making $80,000 to $100,000 in your IUL. You peel off half of your interest you're earning in the IUL tax-free, and you can make your mortgage payment and have as much left over. And now you're in control, and you preserve your credit history because now you're establishing credit as an individual by not having to go out and get a new loan. You just don't pay off the current mortgage. You just take over and start making those mortgage payments, and now you've established credit as a widow in 18 months or 2 years by not paying off the mortgage. But again, if you pay off the mortgage, there's only one way to get that money back. That's to borrow it back from a mortgage company and prove that you are credit worthy and need the money. If it's over in an IUL, you don't have to prove anything. You just access that money. Only half of it is required or less to make the mortgage payment. You have liquidity. You have safety of your principal. You have a rate of return. And so widows thank me for giving them that advice, because most are told wrong advice to go pay off all their debts. And then in 2 or 3 years, they're wondering why they can't establish credit as a single woman trying to go out and borrow money or start a business. Okay, does this make sense? And so an insurance death benefit is tax-free. Keep it tax-free. Any windfall, profit, sell of a business, anytime you realize a lump sum of money and you're wondering, what can I do with this? If you do not need all of that money for some goal less than, 2 or 3 years, I would consider a max funded IUL. Because I can put in $500,000 or $1 million or $2 million. I can do it in compliance with IRS guidelines with a properly licensed and trained agent. But if I need money and I have $1 million in there, I can access, I could access 100,000, 200,000. I could access 940,000 of my million without killing the death benefit or anything. It's liquid. You can access the money. It's tax-free. And so you want to make sure you keep that money liquid, safe from market volatility. That's what indexing does. And you earn a great rate of return that outpaces inflation, and tax-free. Nothing else does those 4 things as well as a properly structured max funded IUL. So it's the dream solution for many goals, but for lump sum capital transfer, don't rule yourself out. And if that's all the money you're going to structure an IUL to accommodate, make sure you talk to an agent that knows how to comply with TAMRA. You don't talk to just any insurance agent that jacks up the death benefit to accommodate the lump sum and avoid a MEC, because the rate of return is not going to be very great because they put way more life insurance on you than needed. You spread out the funding of that lump sum over maybe 2 years in one day if you're in your 20s or 30s or 40s, or 3 years in one day if you're over age 50. You'll understand that more when you study about the TAMRA tax citation. So here's how you can learn more. Claim a free copy of my book. Now, this has been flying off of my warehouse shelves. It retails on Amazon for between $20 to $60. If you buy one on Amazon, thank you. But I'll gift you a copy for free. You simply go to laserfund, laserfund.com, or click on the link below. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I will fire out a hard copy to you via priority mail. When you're claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats for your investment. You can even schedule to attend a free educational webinar. No cost, no obligation. We teach them on a weekly basis, no charge, free. You can even schedule an appointment with an IUL specialist, the top 13 out of over 5,000 I've trained in America. They'll help you understand and create some illustrations of how a properly designed laser fund can accommodate lump sums like I've been talking about in compliance with IRS guidelines. It's crucial you have an illustration done correctly so that somebody who does not know what they're doing and they're just trying to avoid a modified endowment contract, they're jacking up the death benefit to 2 or 3 times what it needs to be, which is going to cause you to suffer on rate of return. If you earn 10, you'll net 2. I would rather have you earn 10 and net 9. And that's what happens when you structure it correctly. So thank you for your interest in this. Click on the link below, and I'll see you on the other side of your brighter future.